Herman had been with me a few years when he told me that his financial goal was to leave $1 million to each one of his three daughters. He wanted to leave $1 million to each of his three daughters. He'd been to a financial advisor. A financial advisor had called him and said, look, let me look at your portfolio. I'll give you a second opinion. The financial advisor said, this portfolio is too risky. Tried to sell him on the fact that he was in stocks and that his approach was much better and would be safer. Herman talked to me about it. I said, of course, Herman, that financial advisor is trying to get you to move the account. What did he say about your three daughters? He said, it was impossible to leave $1 million to each one of my three daughters. Impossible. Absolutely impossible. You know what? By the time Herman died, he had enough to leave $1 million to each one of his three daughters. And I'm going to tell you how he did it. That's the focus of today's program. So you're going to learn how it happened. And it's all about the math. It's what I call 10% is the new 4%. I'm going to tell you, because Herman started with me with just a little over 200,000, and by the time he retired, he had put another 100,000 into his account. So 300,000 grew to 3 million. How did that happen? And why did that other financial advisor tell him it was impossible to achieve? That's what we're going to talk about today. Indeed, 10% is the new 4%. Back in the day, when I served on an investment committee, I started my career at Intalco Aluminum Corporation. It was a smelter, second largest smelter in the world. And I was an up-and-comer. I would end up as plant superintendent. But in the early days, I was assigned to the investment committee for the pension plan. And that pension plan was built so it would cover 80% of a worker's retirement check, cover 80% of the final check a worker would have at Intalco. And as we sat and reviewed it, the returns that were in that portfolio were approximately 10%. And what the workers were contributing was 4%. And the employer was not matching that. That was 4% that the workers were putting in, and they were achieving a 10% return. That's where I got to the 10% is the new 4%. Because today, if you look at what's happening, workers are being told they need to contribute a total of 10% to have a retirement paycheck equal to 80% of what their final paycheck was. And the employers are matching part of that. They're matching 3 or 4 or 6% of what the workers put in, but the total between the employees and the workers has to equal about 10%. I'm on my way to the National Association of Pension Advisors Conference in Tampa, Florida this coming week. It starts on Sunday. I'll be there Sunday, Monday, and Tuesday. And that's the focus. They talked about Secure 2.0, which the government passed. Secure 2.0 says is built so workers may start by only contributing 3% and participating in the plan. And the idea is that they increase their contribution by 1% a year until their contribution and the employer's contribution reaches 10%. That's what they're saying. 10% is the new 4%. Because the returns have dropped. It's not that returns are still achieving 10% or 13 or 9% of what I used to see. They're producing lower returns. Look at this chart again. Studies on Investment News, Schwab, BlackRock are showing this is what the average financial advisor is producing. It's a little over 5%. Here's what my clients are doing. here we are. You know, we're producing and giving to clients, if they begin with 500,000 at the bottom of the market in 2009, that would have grown to 7.4 million. The average financial, 500,000, would have only grown to 1.2. So what is the difference? I have to tell you, I'm very, very good at picking stocks, and my clients do better than the S&P 500 with dividends invested. But that's not the biggest difference between 5% and 17%. It's the math. It's really the math. In my opinion, a financial advisor using asset allocation will never achieve this kind of return on that upper level. Think about it. This is what financial advisors achieve. Let me move to the next slide. You've seen this. I'm sure you've seen this. This is the investment risk pyramid. You've seen this before. On the bottom, with the biggest portion of investments, this is what financial advisors do. They stick the biggest portion into bonds and CDs and cash, getting 2 to 4% per year. Safe investments. The next, they put in some real estate and some conservative equities, maybe dividend payments. And they get a 6 to 8% return. And then some growth stocks at 8 to 12%. And if you speculate, maybe they put in gold, maybe they put in silver, maybe they put in alternative investments. For the financial advisor, the rule is do not lose clients' money. That was their number one rule. Number 2 rule is don't forget the number 1 rule. Number 3 rule, don't forget the number 2 rule. Don't lose client money. That's their whole shtick. That's what they do. So how does it work? How does it work in practicality? Let's talk about the math. Start with $1 million. Suppose you started with $1 million. Have $1 million portfolio. You want to do it in asset allocation. You want to follow the standard with the financial advisors, what they do. So let's suppose you want to put the most money into the safest things. You want to put it into bonds, no worry bonds, and cash. So 450,000, 45% goes in at 2% return. You're going to get 9,000 a year. Nice. You don't have to worry about it. It's nice. It's not going to fluctuate very much at all. It's going to be a nice, safe return. So what do you do with the rest of the 550,000? Well, 38%, the next 380,000 goes into that second level where you get a 6% return. And now on that 6% return, you're going to get 22,800. So a little more risky, a little more volatility, but not a whole lot of volatility. You're still very safe. You're not losing any money. And now, what do? You now have invested between those two. You've invested 83%. So you've got 17% left. So what do? Put 12% in growth. 120,000 goes into growth. And now you get 10%. On that 10%, you're getting $12,000. So you're moving up the pyramid. That's the math. Right now, you've got 450,000 at 2%. You've got 380,000 at 6%. You got 12% at 10% at 12,000. And so you have 5% left, and you put it into something speculative at 12%. So you get another 6,000. So there's the grand total. You've invested, you've done it, and we've got it invested. You know what? We're making 49,000, but I've left out one thing. I left out one thing. The advisor has to get paid. So when you look at it, you're generating 49,800 in income. The advisor gets 1%, 10,000. So the return is 3.9. So as I did the math, it's a little contorted, and if actual financial advisors are doing better than this, they're better than just the straight math that I've done, but they're getting 5.1%. And you can see why right now. You can see 450,000 at 200%, 380,000 at 6, 120 at 10, 50,000 at 12, and 1% for the advisor. And you can see, what do we have? This is what we have. It's the math. 10% is the new 4%. Back in the day when I served on those, that investment committee for Intalco, they were achieving 9 to 13% in the growth of that defined benefit plan. 9 to 13%. And employees only had to contribute 4% of their paycheck. Now, since investment advisors are getting 4% or 5%, now Congress and the industry wants you to save 10%, not 4, 10, and invest it in your 401k. And that's where I'm headed off to this week to talk about the National Pension Advisors. And they're doing this. This is why. This is the biggest difference between what I do and what most financial advisors do. The investment pyramid, the very, very, very safe bonds and CDs and cash, but they pay the lowest. Less volatility, but they pay the lowest. Some real estate and equities pay a little more volatility, but still not a very good return. Growth stocks, 8 to 12%. I'm getting close to 17%. So, and maybe the financial advisors get better than 12%. Maybe that's the difference between my 3.9. And then speculative investments. And for me, what's happening right now is there's a bigger and bigger focus on that area. And they're beginning to plug that area, thinking that it's more just covers that entire pyramid, putting in income type investments like private credit. They're putting in private equity. They're putting in private real estate. They're putting in different things to achieve a little higher return in theory. The question is whether those alternative investments are really going to be investments. It's not a return on your investment. The question in my mind is whether it's going to be a return of your capital, a return of your investment, not on your investment, of your investment. We've talked about private credit in the past and why it's a real problem. Jamie Dimon says when you see one cockroach, there's others. And he was talking about these alternative investments. We've seen a number of turn upside down. So the question is, if you're only in 4 or 5% at a normal financial advisor, you're not risking very much if that's your alternative investment. If you're moving down the scale, moving speculative even higher, there's a bigger and bigger risk. And it may not show because stocks are priced every single day, every single hour, every single minute. So you know exactly what you have. Bonds are essentially priced, but the other investments are not priced. So it looks as though they're doing well, when in fact they could be collapsing. The investment risk pyramid, 10% is the new 4. That's what we're talking about. That's why our clients, 500,000 has become 7.4 million. Why? The average advisor is only producing 1.2%. The plans that we're seeing today are underproducing, and the financial advisors are trained to do financial planning. There was a time I got into the business in 1986. The only people doing financial planning were the people who were driving taxis and shining shoes. When the market crashed in 1987, Merrill Lynch came along and said, trading has dropped off a cliff. Not just Merrill Lynch, but Paine Webber and all the major brokerage houses were in a panic over how to keep investment and keep the dollars there and keep them from fleeing to go to CDs. What they did for Paine Webber, where I was at the time, they did a 6-month annuity renewable paying 7% and no cost to the clients. The whole purpose was to keep the money at Paine Webber and not let it fly away. And the investors were paid a significant premium. It was a loss leader. At Merrill Lynch, they came up with the idea of doing financial planning. And in those days, most of the stock certificates and bond certificates were held by the client, not in an account. And Merrill Lynch came together and thought, with financial planning, they can bring all that together, know where everything was with everyone. And so they did that. And in those days, in 1987, 1988, Merrill Lynch required each of their financial advisors to sell a financial planning program for $245, as I recall. Could be wrong. But if you didn't sell one a quarter, then your payout grid went from 40%. The gross revenues you generated went from 40% to 25%. So there was a huge incentive to do financial planning. And they began to attract money in. It was about gathering the money in, and everybody saw what they were doing. And suddenly it became a thing for the entire industry. But in order to justify what was doing, they had to come to that investment pyramid. So if you look at the difference, why my clients are achieving 7.4 on 500,000 over these last almost 16 years versus 1.2, it's not about always picking better stocks, although I think I do that. It's about building a better structure. It's about building something that works better. It's not the investment pyramid. And yes, there's greater volatility, and that shows up on the chart. There is greater volatility because we're in stocks. But just saying greater volatility is greater risk, is it more risk to be at 1.2 million or 7.4? No, that's the question. And I have to say, the past performance doesn't guarantee future results, but the math is sound. The math is sound. We don't have to be 10% savings. We can be 4, because that's where it comes down to. Herman started talking about Herman. Herman just had 300,000. Herman's story began with another client, Gary, who opened a small account. Gary got married to Nancy. They got divorced. Nancy kept her account. Gary didn't want to have the same financial advisor. Nancy stayed with me because she saw what I could do. Nancy married Herman. And when Nancy passed away, Herman stayed here. Nancy's money went to her children and went away. Herman stayed here with $300,000, and that grew to $3 million. It grew because of the way it was structured. It had this type of portfolio, and it had this type of growth. That's what it did. It grew tenfold. Herman met his goal of leaving $1 million to each of his 3 daughters, a task that was called impossible by another financial advisor, because that other financial advisor used that investment pyramid. Past performance is no guarantee, but the math is sound. That's what we do at Adams Financial Concepts. Those are the results. Those are the results. This is what it looks like. This is where we are. And yes, there's greater volatility. Look at this. This line is more jagged, but it begins here and it rolls here. The average financial advisor, you don't see it bouncing very much, but you see a huge spread. Look at that. Portfolio structure brings it up to here. And this is superior stock selection. If you look at where I've been since I started in this business, that's what's happening. If you look at it compared to the Standard & Poor's 500, yeah, we're achieving 17.5% versus the Standard & Poor's 15.8. And first quarter numbers are just coming in. I've seen the rough draft. I haven't gone through it, and it looks like we're down a little bit for the quarter. So we'll still be above the S&P 500. And if I look at the numbers in April, we're above this point. We're up here. That's where we are. Past performance is no guarantee of future results. I like the disclaimers we have because you can track and you can verify all those results. That's why it happens. That's why we're here. And with that, I want to leave it open for questions and discussion. What would you like to know about what we did?
Hey everybody, it's Chris Prouty, and I am rejoining the conversation. I'm here to keep an eye on the webinar chat or the Q&A. So if you have questions that you'd like to ask, you can put them there. Just understand that if you put them in the webinar chat and you send them to everyone, then everyone who's in attendance will see them. If you want to send them just to me and Mike, you can send them to host and panelist. And Mike, somebody says, I feel like I'm doing okay, but how do I know if that's actually true?
Just look at the numbers on the S&P 500. If you're getting close to that, you're doing okay. If you're managing your own money, if you're getting close to the 15.8% that's been achieved on the S&P 500, I would say if you're getting 12%, you're doing better than a lot of money managers. If you're doing
Mike, somebody says,
go ahead.
oh, yeah, somebody says, is 14% return achievable or more of an outlier?
I've been doing this for 40 years, of which I tracked my numbers beginning after a couple of years in the business. And during that period of time, I have beaten the S&P 500. Not every year, not every year. About 1 out of every 3 years, I underperform. But yes, it is possible. And when I began tracking my numbers, I was with the big brokerage firms, and you weren't allowed to talk about your returns. They didn't want you to talk about the returns because they know how most people did. Actually, the big firms do track how you do, but they don't share that with you as a financial advisor. But since I formed Adams Financial Concepts, you can go back and verify that I achieved what I say for each one of my clients. You can take it down, and if somebody really wants to do it, I can give all the information. It's all there. You can track it down. You can look at every single client performance, and you can look at clients that were with me before I started Adams Financial Concepts. You can look at clients that have been with me since 2005. Clients that have at least 1 quarter of data are in those numbers. Clients that have left, who have passed away, who have moved their accounts for whatever reason, all those clients are in that composite as well. It's verifiable. If you want to spend the money to verify it, I'm willing to provide the information.
Mm-hmm.
Absolutely, for sure.
Mike, somebody says, what happens to my plan if Medicare costs shift back to me?
You need more money.
Pretty simple.
Your plan is going to have a problem. Medicare, Social Security, all those are on the table. I mean, at Easter, President Trump announced that we can't do child care, we can't do Medicare, we can't do Medicaid. We need to spend $1.5 trillion on the war, on defense. And so we can't do all the programs that that we have. We can't do food stamps. That's what Congress is talking about. They want to cut those programs so that they can spend more on the military. Do you think that's to your advantage? Really? To your advantage? To spend more money on the military? Anyway.
Mike, next question. Your approach seems different than every other advisor that I've talked to. What is it about your approach that you think is different? I'm kind of paraphrasing that one, but I think that's the spirit of the question.
I think I just explained.
Yeah.
We don't do the pyramid. We focus on, I have a passion for creating wealth. Truly have a passion for creating wealth, and that's what we do. We're not, there are times when we will have bonds in portfolios, when we will be conservative and we'll have cash. But those are times when we're looking at the market and the economy being down. But otherwise, we have a passion for creating wealth.
And Mike, on that topic, I am putting into the chat right now a link to the YouTube channel where people can find past episodes of the podcast, as well as a whole collection of other videos that will be very useful to you. And that link is in the chat right now, and it is About Money Radio on YouTube. And we ask that if you happen to visit the YouTube channel and you find value in the information that Mike is sharing, if you'd give us a quick subscribe, that would be meaningful to us, and it signals to YouTube that we're creating valuable content and helps us surface for more people. Also in the chat, I have included Mike's email address, which is mike@adamsfinancialconcepts.com. You can send him an email with direct questions, and I have on good authority that he reads and responds to every single email. So you can email him there. And Mike, that wraps up the questions that I have in the chat. However, I have a question for you, Mike. What is on tap for next week?
Coming up next week, bull markets ignore bad news. Bear markets ignore good news. We're ignoring some very bad news today. I like the phrase out of Ecclesiastes, phrase of just 4 words. They're the most loved words. They're the most feared words. Ecclesiastes, whether you're on the top of the mountain or in the lowest of the valley, the words apply. And the words are, this will not last forever. If you're on the top of the mountain, you know it's going to come down. If you're in the valley, you know it's going to turn up. That's Ecclesiastes. If you're in a bull market, you know it's going to turn down. And right now, it's ignoring bad news. That's not good news. Bear markets ignore good news, and things tend to get better. That's the program for next week.
I'm looking forward to that one, Mike. And Mike, with that, we have all the questions wrapped up. Keep an eye on the chat just in case anything else comes in. But with that, Mike, I'll send it over to you for the final word.
We'll have a very good week. I will report back on bull markets and bear markets and where we are and why I think we're coming to a very bad time. And it's time to prepare and prepare in order to not only survive, but to thrive, because people do at times thrive through bear markets. And with that said, I wish you a very, very good week and a very nice weekend. And I will be back on Thursday. Take care.